the only thing I'd get a loan for is an investment. Everything else I pay if I can afford it. So I wouldn't buy a car on a loan. You know what I mean? But some people need a car in order to earn money. So the banks look at a fully paid off credit card as not being good for borrowing capacity.
No.
Yep.
They are fully paid off. You need to cancel it.
If you're on the call a couple of weeks ago, we've got the new Super 6 now. So even if you got, you know, like 100 grand in super, you can still get a property now, which is pretty cool. So the key is every time you get investment property, it's like getting a little business that you own and the tenant's working for you, the taxman's working for you, and they're paying off that loan, but they're also paying off your principal interest. Principal property.
PPR.
I can't even say it, right?
PPR.
I've been rent vesting for so long. Okay, we're going live. Hello, this is George Markoski. I've got Barbara here with me. Welcome to Money for Life. The RBA has held rates. No surprise there. But what does this really mean for investors? See, most people will shrug and think, no big deal. However, there's a little bit of nuance here, and that's what I want to talk about tonight. Anyway, welcome, Barbara. Good to see you.
Thank you. Thanks, George. Nice to be here. I recognise a few names up there.
Yes, absolutely. So what I'm going to do is I'm going to go through the state of the nation and just go through the stats and show you what's been happening in the world. Then afterwards, me and Barbara are going to have a deep dive on interest rates, finance, everything else. We've got Barbara here from Wealthstreet, which is very exciting. And what I'd like you to do, if you've got any questions about finance, start typing the questions in the Facebook group or in Zoom, and then we're going to go through and work through them all, which is great. So now I'm going to get my presentation. Okay, state of the nation. FOMO sends house prices to orbit. So last week's national final auction clearance rate increased to 71.6%. This is the highest result for capital cities since June 2023, so for 2 years. And what you can look at this graph, just to tell you what the significance is. You got the blue line, that's auction clearance rates, and then you got the red line, which is quarterly price growth. And when the blue line goes up, prices go up. When it goes down, prices go down. So that means auction rates are up, means prices are going up. So, you know, there was an interesting story in the paper about a buyer that was paying $750 a week rent, who's over the moon about the fact that he can now buy a property worth $1.5 million threshold, allowing him not to have a mortgage insurance, and he can buy it with a 5% deposit with the new scheme. However, the mortgage of $1.5 million property at 5% deposit is going to be $8,200 a month, far above what the buyer is paying for in rent, which is $3,375 a month. And what's happening is the fear of missing out, and the fear of missing out always precedes a boom. So there's a lot of FOMO going on at the moment, and the government now has got that new scheme of 5% deposit with no mortgage insurance. And what they're trying to do is make housing more affordable. The challenge is, as we know here at Positive Property and Money for Life, that the only thing that matters when it comes to prices of property is supply and demand. And now if the government creates more demand by dropping interest rates, not interest rates, deposit, the 5% deposit, that's actually not going to help supply. It's going to do the opposite of what they're trying to do. So the RBA holds on research and inflation risk. So the Reserve Bank has chosen to hold the official cash rate at 3.6% in what was a unanimous decision. They've noted inflation is slowing less than expected and may come in higher for the September quarter. So they've stressed it's going to stay data dependent, meaning November cut is not guaranteed. And that's what we're expecting anyway. Inflation's still high and it hasn't gone down as much as possible, and that's what's going to happen. I'd be curious to see what happens in November. Now, I want you to look at this graph. So the blue graph is average vacancy rate as a percentage, and average rent per week is up there. And as you can see, what happens is, as the vacancy rate goes up, the graph average rent is the opposite. So it's a mirror image, right? And basically, Chief Economist Shane Oliver posted this chart detailing the path of rental vacancy rates and asking rents since 1980s. So you can see the three blue circles up there. There have been three major surges in asking rents over the last 40 years. The mid-1980s, the run-up to the GFC, and immediately after the pandemic. Now, part of the reason for this very different peaks in growth in asking rents is down to differing rates of wage growth and inflation during the various eras. But have a look at this. If you look at this graph here, net overseas migration, and then you look at rents, and migration goes down, asking rate goes down as well. So the relative performance of net overseas migration prior to and during the first two surges in asking rents on AMP's charts, the correlation between the two is swiftly clear. So you have more migration, rents go up. They go down, rents go down. Basically, a robust dwelling completion cycle was still contributing to keeping growth in asking rents under control back in before. But now we don't have that. Now, asking rents are up more than 50% compared to pre-pandemic peak. Now that's huge. And now rental vacancy have plunged to a new record low. So our average vacancy now is 1.4% in September, with only 1.1% of Australian units and 1.7% of houses estimated to be vacant available for lease. Considering the record decline in national vacancy rate, the number of homes listed for rent has collapsed to a record low, down 17.4% year on year. So we've never had this low vacancy, so hardly anything is available for rent. And the decline in rental vacancy rate and the re-acceleration of rents correspond to a surge in net permanent and long-term arrivals recorded by the Australian Bureau of Statistics, as illustrated below. Yeah, so that's amazing. There's hardly anything available. That's it for the state of the nation. I'm going to go through some member wins and then we're going to start our presentation. Okay, Tristan from Queensland. He bought in Bow Desert, settled in April 2025. The price is $419,000, deposit $42,000, currently valued at $555,000, $136,000 profit, return on his investment, on his deposit, 325%. And Tristan's now an Orange Belt, so he's got 3 properties. This is Greg and Charmaine from New South Wales. They bought in Moorfield, settled in 2024. The price is $520,000, $52,000 deposit, current value $655,000, a profit of $135,000, return on investment $261,000. Well done, Greg and Charmaine. Barry from Bali. This is one of his properties. He bought in Birkenberry 2021. Price is $485,000, deposit $49,000, current value $875,000, current profit $390,000, 804% return, and he's a red black belt, nine properties. And he's actually got the Katana of Freedom because he's actually retired now. And he came along to our workshop. So let's get into it and let's talk finance and everything else like that. So if you have any questions about finance, Claudia Cooper said, what a disaster, but not for us. Yes, it is a disaster. And we can see that graph. And unfortunately, Australia is the disaster of our property prices and rental crisis just keeps rolling on. So one of the questions a lot of people have, Barbara, is how do we increase our borrowing capacity? Because during the 2 days in the workshop, you know, we were there in Bali for 2 days with our members then, with 50 investors from Australia. And the 2 things we found were the biggest constraints. The number 1 constraint in investing in property, funny enough, it's not borrowing capacity, it's mindset. And this is the thing, we had people there that have been with us for a few years, and we had quite a few people break through their mindset and be able to get more properties. And it's really amazing because when you're creative, how you find new things. But borrowing capacity is the second constraint that we have, that we're always working on. And what are your thoughts? How do we fix that? What do we do there?
Great question. It's always things that the banks look at. If you've got credit cards, get rid of them. Credit cards hold back your borrowing capacity by so much. When we go through strategies with clients, we show them, you know, for the 10,000 credit card, that's $500 to $600 a month that has to come out of their everyday spending. So, and they add that on. getting rid of credit cards, you stop doing things, little things like Uber Eats, all those sort of things, because we do go through your living expenses and so do the banks.
Okay, so Uber Eats, really?
Mm.
That's if we disclose it, correct?
Okay. And
Not
it's better
saying
to
that we shouldn't.
disclose it because
I'm not saying that we're not going to disclose it. I wouldn't say
no, definitely we will disclose. Well, it will come under obviously dining out, and that will come on top of your everyday expenses. Yeah, exactly, Robert. It's on your statements, and the bank's got the right to ask for those statements. So
all
they
right.
can have a look at those. Yeah. And I mean, we always look at HEM, which is like the household expenditure measure. We always try and keep your expenses around that. But you don't want to get caught out if the bank asks for that statements and you've got things like taking I was just going to say that taking cash out of ATMs because you can't, there's no trace of it.
Oh, really?
So if you're going to go and buy furniture, don't take cash. Use your card because we can deem that as discretionary. So a discretionary thing is something that is not your everyday living expenses.
Yes.
So if you're doing a holiday,
If you're not buying a couch every month, it's a discretionary.
exactly.
Right?
Yeah. So if you're doing a holiday, we'll deem that as discretionary if you're buying, furniture or a car. But if you're taking cash out to do it, that's cash, has to be added in
Oh, really? Okay.
as an
So,
expense.
so taking cash out is not as good.
Yeah, correct. Yeah, obviously gambling, things like that. If you do that, stop.
Yeah, well, gambling's not really good for long-term savings anyway. Like
Correct,
it's been proven,
exactly.
it's been proven to
Yeah.
be terrible. Definitely.
And I
Definitely.
mean, even a good way to free up servicing is by consolidating debts. So if you've got a lot of personal loans, credit cards, things like that, consolidate them into one loan. The repayments, we can extend those over, if it's a personal loan, over 10 years. It just frees up that cash or refinancing them as we get the
Yes.
equity out.
I think at the end of the day, what you want to do is look at all your different debts and look at what interest rate you're paying. And then what you want to do is roll them into something of lower interest because,
Yeah.
it's crazy because the way I see it, me personally, the only thing I'd get a loan for is an investment. Everything else I pay if I can afford it. So I wouldn't buy a car on a loan. You know what I mean? But some people need a car in order to earn money. So that's a little bit different, right? Because then
And I mean,
investment.
yeah.
But you don't need, a brand new BMW to go to work and back, right? Because having a BMW or a Porsche or whatever, save that till after you got passive income and you can afford it. Because the way I see it is, active income and passive income are very different. Because active income you've got to work for, so you want to save every cent and really invest it and work hard to do that.
Another good strategy as well is salary sacrifice. If you can salary sacrifice, because we look at that as net income. So if you can salary sacrifice, say, into a spending wallet, that frees up cash as well. So it's classified as net, comes off of your gross, and it will be net.
Okay.
So look at salary sacrificing, with your bank.
How does that work, the salary sacrifice? So what do you salary sacrifice for? For a car?
Well, you can actually, like if you're a nurse or something like that, you can put it into a spending card. Okay. So you can put it into what's called a wallet and it's actually a spending card. So you might say, I want $1,000 salary sacrificed into my everyday living account. It depends on your occupation as well, but that is one. But yeah, leasing a car as well is better than probably taking out a loan because that's tax-free money.
Oh, it's tax-free, is it? Yep.
Salary sacrifice. So we'll still include the debt, but it sort of frees up tax benefits as well. I can't advise on tax,
No,
but
of course that.
it
But
does.
Adam Bella was saying, so the banks look at a fully paid off credit card as not being good for borrowing capacity?
No,
Yep.
they are fully paid off. You need to cancel it. If you've got a 10,000 limit and it's at zero, the bank's still going to look at it as a 10,000 limit.
Yes.
That you owe 10,000.
What I do is I lower my limit right down on all my credit cards, get my loan, and then bring it back up again.
The banks look at the card and look at the total. Yeah, exactly. Yeah.
That could be spent, exactly.
Yeah, salary sacrifice into super as well. We can include that as tax-free.
You could. The salary sacrifice to super, you got to really be strategic with that because what we want to do is buying property in super is not as good as buying property in real life because we can't use the equity to grow it and you can get stuck. So you've got to look at how much you've got, and if your salary sacrifice to super, how long it will take you to get a property compared to real life. So there's a few calculations you need to do to make sure it's worthwhile, because I always believe a property in real life is so much better than one in super. But I think a property in super is so much better than not having a property in super. So it works. And if you're on the call a couple of weeks ago, we've got the new Super 6 now. So even if you got, you know, like 100 grand in super, you can still get a property now, which is pretty cool, which is exciting.
Very.
There you go. And
no, but the salary sacrifice to your super, if your salary is sacrificing 30,000, we'll look at that as net income and add it back in, because it's a discretion. Look, you can cancel that at any time. So we just put notes to the bank and we can include that as your income.
okay, Jeff Butler, how much does tertiary loans and the payment of those debts affect borrowing capacity? Should you pay that loan out of, you have cash to do so?
Ooh, that's a good question as well. It depends on how big the debt is, and it depends on how much you earn. That would affect the, yeah.
Sometimes you don't have to pay it back until you earn a certain amount, correct?
Correct. You have to earn over, I can't remember what it is. I think it's 70 or something now. They
Yep.
did change that. They did change the ballpark on that. But it depends on your income and depends how much is owing. Because I mean, you might only have to be paying $100 a month off of it.
Because I'd imagine the interest wouldn't be very high on that actual
No.
tertiary thing. So,
but we can go through that. Yeah, we can definitely go through the difference of having a HEX debt or not having a HEX debt, and show you the impact of the service.
if it's lower interest, then it's actually better having it as a HEX debt than getting a high
Maybe.
interest and paying it off.
Yeah.
Right.
Yeah.
You got to really look at the numbers. That's the
Correct. Yeah, it's all individual on that one, but yeah, definitely we can go through that and work out exactly what the difference would be. We have 2 loans on one property, both are in personal names, but one is for residential under trust and the other is investment. Oh, so Deb is just need to know the one's under the trust name, is it? What's the title on the property? That would make the difference. Is it under the trust name?
Darren, are you there? So the title is under the trust name, yeah.
The trust name? Yep, we could amalgamate both those.
Yeah.
Yep.
I'd imagine amalgamate.
Even though one's in our personal, yeah.
Yeah. Oh, one's in your.
They're both in personal names. The ANZ stuffed up and put one in a personal loan, even though it's a trust, even though it's the property's in a trust. And so now we've got a loan. We've got 2 loans against the property. That just came about. There's 2 loans against the property. One's an investment loan on high interest, a smaller amount. One's higher amount, but on a lower interest. But we were told by ANZ that it would need a lot of mucking around to amalgamate them, because we really just wanted them amalgamated as one big loan, seeing as they're both off the same property.
Yeah, well, before amalgamate them, I'd look at what the result would be and make sure that you're in better off position. And if you're not, I'd keep them the same. That's what I'd do.
Okay. The concern is that we've got our offset account on the higher interest one, which is a smaller amount, but it just means that it's because it's just interest only. All it's doing is we're just paying the interest.
Yeah, interest only is fine. I like interest only. I prefer interest only loans, and I prefer it on the high interest account.
Yeah.
So I think you really set it up perfectly, which is great.
Okay.
That's what it sounds
so
like.
that loan will never get any smaller.
No, but it will get smaller. That's the funny thing. It's going to get smaller every year. I'll tell you why.
Okay.
There's a thing called inflation at the moment. See what? So the RBA didn't reduce rates because inflation's high. What inflation does, it shrinks your loan because of purchasing power. So your loan shrinks every year because inflation grows and your debt is smaller, dollar for dollar. Does that make sense?
Yeah.
So your loan is shrinking anyway, even if you're not paying off. And that's the reason we don't pay off loans, is because inflation's doing it for us anyway. And we can't really help that much because inflation does all the heavy lifting. It's the 80-20 rule.
Yeah. But we're just paying, so therefore money's coming out of our account. The money's going somewhere. It's going into the interest.
Yes, but if you cover,
Third
so let's say, for example, the higher interest is $100,000
Mm-hmm.
and you've got 100,000 in your offset account,
Yeah.
you're paying zero interest on that part of the loan.
All right. So just try and keep our offset account up high.
So what you do is really you want to get every cent you have and put it in the offset account with the highest interest. Or, sorry, that's wrong. That's the second thing you want to do. First thing you want to do is put your money in your offset account with bad debt.
Yeah.
Bad debt is your owner occupier. Then
Yep.
you put the money on your investment property of the highest interest. Because if you've got an owner occupier, you owe money on that. I'd rather you have money on that because that's bad debt. This debt you're getting a tax deduction for anyway.
Oh, okay. All right. That sounds good. That's what we're
That makes
doing.
sense.
And I just want to make sure that we're doing the right thing.
There you go. Perfect. That's exactly what you do.
Thanks, George.
No worries.
And Sharon, is it, if you have a personal home loan and a loan with the equity was released for your, can you amalgamate them? Not a great idea. If the personal loan, oh, hang on. Oh, so you did a equity release loan and a refinance of your owner occupied, I presume. So you want to keep them separate because the equity release for the investment property is what is used for the investment property, and that's what you can claim on your tax. I wouldn't be putting them together.
No, we actually want to keep them separate because then you know what your good debt is, bad debt is, and we're keeping them in separate buckets. So that's the way we do it. So Sharon, you got it exactly the way it should be.
And if you want to pay down, yeah, smash out your owner occupied, not your investment. Investment should always be interest only.
Don't pay your owner occupier off either. Just put it in the offset account, save the money, and get another property.
But you can use your redraw. I was meaning.
Yeah, absolutely. Because look, what we want to do ultimately is get enough investment properties where your tenant is paying off your home for you. That's the key. Don't pay it off yourself. Get more investment properties and get them to pay it off. So the key is every time you get investment property, it's like getting a little business that you own and the tenant's working for you, the taxman's working for you, and they're paying off that loan, but they're also paying off your principal interest. Principal property.
PPR.
I can't even say it, right? I've been rent vesting for so long, right? And that's why. So then what happens is instead of trying to pay it off, we get the extra money we've got and put it into another investment property to pay it off quicker and get another one and keep doing it until you leverage enough. When you've got 5 or 10 properties paying off your principal place, happens very quick, really quick. And that's the way you want it.
Equity is marginal between either one property with no LMI or two properties at 90% at 88 plus LMI. Is it worth taking the hit on the two properties and paying the LMI in the long run?
Good question.
Are they for investment properties? Remember, it's all tax deductible, whatever you pay.
Yeah. So Robert,
all investment properties.
Yeah. So Robert, it's a beautiful question. Robert, it's a beautiful question, and I love that question because that's a really powerful question. And I want to answer it because I really enjoy that question. So basically, you're talking whether to buy one property and you pay less LMI because you're not paying any, or buy two. And the way I see it is always go for two instead of one. Two properties are better than one all the way. And LMI, what's LMI on a property roughly, Barbara? 5-10 grand?
Depends on the loan, yeah. But I mean, you just add on to the loan.
1.5%.
That's a tax to, yeah.
1.5%. So basically you're paying a 1.5% premium. Now, you've seen some of the results people are getting. So, is it worth paying a 1.5% premium, especially when you're looking at people making, 100%, 200, 300% of their money in 1 year? Yes, it is. It's nothing. And it's really worthwhile. So LMI is lendage mortgage insurance. And you have to pay that if you've got less than 80%, right? And
if you borrow more than 80% of the purchase price, lender's mortgage insurance is applicable. So realistically,
it's a sliding scale from 80 to 95. Is that right?
Yeah. So it's not a standard rate. So if you're looking at 90%, no banks will go over 90% for an investment property at interest only. So the maximum, as you put there, the maximum we could lend would be 88% plus the lender's mortgage insurance.
Yeah.
And it does vary between banks. Some self-insure and some outsource to someone like Genworth. So they are a little bit different. But yeah, 1.5 is, if you base it on about that.
Yeah. So look, as a general rule, I prefer not paying LMI because why pay it? But my other rule is you want to get as many properties early as you can. And if you have to pay LMI to do it. Because the name of the game in property is getting them early and holding on to them. Because we've had a really big run with properties over the last 20 years, right? Since I've been doing this program for the last 20 years, we've just been getting hit after hit and property's been growing so much. Now, properties grow at different rates too. And we're looking at the last boom of the 20s happening right now as we speak. And we don't know when the correction is going to happen because no one's got a crystal ball. Properties are going to go up, then they're going to correct. And what you want to do is get as many properties as you can early on to get enough growth to cover the correction. And that's the whole key.
Another thing as well, it's like interest rates. A lot of people are focused on interest rates, but when it comes to investment property, sometimes, you might have to take that hit and do a little bit higher interest rate than what you're expecting, especially over 80%, the interest rate is higher. But, at the end of the day, you've got your property, you're going to have the growth of that property, even if the interest rate's higher.
Yeah, look, the important thing is when it comes to interest rates, it all comes down to the cash flow calculator. And really, at the end of the day, you've got to do the cash flow calculator, do your due diligence. You look at the numbers and you've got to say to yourself, can I afford it or can't I afford it? And if you can, you should do it. And if you can't afford it, you shouldn't do it. Really black and white. I urge you, if you can do it, you should do it. And I urge you, if you can't, please don't. Because you don't want to buy something you can't afford the weekly payments because you'll end up in trouble. That's the fact of it.
And we wouldn't let you do that anyway in finance.
No.
I won't
let them do it. Good, because that's important because we don't want people going ahead and getting something they can't afford. But if you can afford it, get in there. And when I started investing in property, that was back in the 90s. Back then, we had high interest rates. It was like 9% when I was investing. And every property I bought was minus $300 because I had the wrong structure. It was P&I. I was getting no tax deductions. And after buying 3 properties, I was paying like $900 a week. So I was literally working Saturdays and Sundays extra to pay for my properties. And that's what started me on this journey because I was like in my 20s, investing in property. All my friends were out partying, having fun, and me, I was working and couldn't really do anything. And I thought to myself, I had a choice. Choice was either give up property, try to find something else, or really work property out. And then guess what I chose in the end? Because I chose work out property because 90% of self-made millionaires made it through property. I wasn't born with a silver spoon. I wasn't going to inherit anything from my parents. That wasn't going to happen. So I had no choice and I had to learn. And that's how I ended up in Miami, having the apple martinis with Nick and learning about property and coming back here. So that's the whole journey, I suppose. So it's funny how my journey was more because you can end up in an amazing journey, either through inspiration or desperation. And mine was definitely desperation, not inspiration. So there you go. Okay, we got any other questions? Okay, so basically, you can see what's been happening. The government's getting the 5% deposit. We've got immigration coming through. We've got the lowest vacancy rate we've ever had in Australia. And we've just got hardly anything available to rent in Australia. This crisis is happening right now as we speak. And the only way we're going to get through it is creating more supply. And the only way we're going to do that is by investors buying more investment properties so people can rent them out. So it's a great opportunity to help other Australians, but also help yourself make some money through this crisis, because in Chinese, crisis and opportunity are the same thing. Okay, Jeff Butler.
One loan broker encouraged us to get a trust to help be able to purchase more properties quickly, but there was no tax benefit. The cost would hurt at the moment, so we decided to get a loan in our name. Is there a clear point when you should do a trust?
Jeff, good question. The thing is, depends if you own your own business or not, and if you can actually take those losses and use them somewhere. Because if you can't use the losses, this is an accounting question, not a finance or property investment question. It's only if you can use the losses, because the biggest thing about buying property is we're getting 80 to 100 grand of tax deductions when you buy a brand new property. And that's what helps you with the cash flow and helps get you to where the property is going to go up, because it's the first 5 or 10 years where we're banging out that 80 grand that's going to help us go through that. Because literally what you're doing is you're actually getting your tax dollars, and instead of giving the tax department, you're putting it into investment property. It's amazing. But if you're buying a trust and you're an employee, those tax deductions are quarantined to that trust, and not sure if you can use them because your income is not going to be affected by it. That's the problem. So people that own their own business sometimes can have a complex structure, and that can work that way. But if you're an employee, no point having a trust at all. But I'm not an accountant, and I would check with an accountant, because they're going to give you tax advice. And, you know, I know a little bit about tax, I would say, and a lot about money, but probably not enough to give people advice. Well, I'm not qualified, but then again, I'm not qualified for a lot of stuff. I'm qualified for investing in property because I've got an MBA in property. Like Sharon, I've been told that 2 more properties will tap me out. Okay, Robert, good question. Yes, so let's talk about that. Okay, I can't see how to break the ceiling when he's talking 5 to 6 for borrowing capacity. Yeah, okay. So a lot of people's concern is, Barbara, is, you know, like Robert said here, he's been told 2 more properties are going to get tapped out. I've, in my journey, owned property over the last 20 years, I've been tapped out many times. But I keep getting up. I keep getting knocked out by the borrowing capacity. They knock me down, I get up, and I fight again. And that's what happens, because things change, policies change, interest rates change, property prices go up, rents go up, your wage goes up, you've got more money in your offset account. All these little factors add up to getting back in the game, right? And we've had a lot of people that joined, they got 1 property, got tapped out, or they got 3, they got tapped out. Then they're back in the game a year later or 2 years later. That's the reason why our program is 10 years, because we call it 10 properties in 10 years, because it takes 10 years to get 10 properties. And yeah, sure, you have people like Barry who got 9 in 5, and he just came in at a really good time, was very aggressive and bought a lot early. But not everyone can buy 9 or 10 properties in 5 years. And that's just the way it is. Some people need to wait longer. But the fact of it is, this is a true fact. As long as you're in it long term, property is going to make you a lot of money, and you're going to get more properties under your belt. It doesn't matter how tapped out you are now. If you are in the game long enough and you do everything the right way, the way we show you, the way we structure it, with our loans, with our offset account, the tax, with the tenant, with getting rents going up and everything else, you're going to get more borrowing capacity as you go along. That's our whole program is designed to help you create that long borrowing capacity. But borrowing capacity doesn't grow overnight. It takes time. Okay, so Brian, good question. How about using a trust to preserve borrowing capacity if you're tapped out in personal name? Or what other options are there to keep moving forward with investing?
Going to make much difference if you're the guarantors of the trust. They're still going to look at your servicing or your income. So it depends on how your trust is set up, where the funds are actually flowing through, which is, you know, if you've got a company and the funds are flowing through that, it's your money anyway. It all comes back down to the same servicing, really, how the trust is set up. I suppose the next step, if you've tapped out in your own name, Self-managed super fund is the next option. It's a one that you can get a couple of properties in self-managed, and then once things change, interest rates change, your income changes or whatever, you can start looking at your personal as well.
Barbara, I love that. That's a really good move. And I totally agree. The fact of it is, look, there's a lot of people out there, I've seen on the internet, and they're like, get a trust, get unlimited borrowing capacity. That is the biggest load of BS I've ever heard in my life, because someone needs to own that trust and someone needs to be responsible. You can't just get a trust and get unlimited borrowing. The banks aren't stupid. And the people going out there talking about this and trying to promote it, they're full of BS. It doesn't work that way, right? The fact of it is, the banks are always going to look at servicing ability. They're going to see, how can you pay for that loan? You can't just set up a trust, the canary owns it like in Simpsons, and then suddenly you can do things, whatever you want. And what Barbara said about SMSF, that's a great way to get another property. And the beautiful part is now Super 6, even if you got one in your SMSF or you can't get one because you don't have enough, even if you've got 100,000 in your SMSF, so literally everyone's got 100,000 in their super fund, you can get another property now with our new program. And what I was going to say, the people watching our public broadcast on Facebook, if you've got 100,000 or more in your super and you want to get a property and you're frustrated that you can't get one anywhere else, type in super, #super in the comments, and my team will reach out to you because we're going to be able to help you. I'm very excited about this because it's exclusive to us, which is great. Okay, Robert, my first property is cash flow positive. Does the positive component able to be used as an income against the next property?
The whole idea of it.
Yes.
Whole idea of doing this.
Robert, beautiful.
Yep.
There you go. Yes. As your cash flow goes up, as you get more rent, it improves your borrowing capacity because the banks look at that. They're looking at how much rent you're getting. Trevor, in relation to the weekly tax rebates, how do you set it up, and do your properties need to be negative geared? Trevor, good question. Your properties, negative geared is an interesting question because your properties don't have to actually be negative geared for you to get tax deductions. That's the thing. So I'll explain how it works. You've got negative cash flow, neutral cash flow, and positive cash flow. That's the three types of cash flow you can have. But then on top of that, you've got gearing, which is negative gearing, positive gearing. And they're two separate things. So what can happen is you can actually make money every week, but still be negative geared at the same time and still get money from your tax. So what happens is with your tax, and when you're buying a brand new property, you've got this thing called depreciation. And depreciation means that, the oven, the sink, the walls, all going to go down in value as they get used. So what we've got depreciation on the fixtures and fittings and also on the building. And the fixtures and fittings, they depreciate down over 10 years, and the building depreciates over 40 years because it's lasts a bit longer. So what happens is you can actually get a quantity surveyor to give you a little thing written down about what they expect it to go down in value. So each item's going to be different. Dishwasher's got to go down a certain amount, curtains, everything else like that. And when you get this quantity surveyor report, it's called a depreciation schedule. And once you got that depreciation schedule, you can take your accountant and you get a tax deduction at the end of the year, which is great. But what we like to do is we like cash flow. And cash flow is king. So what you can do, there's a little trick called an ITWV, internal tax withholding variation. It's a long word, but it's pretty cool. And what this allows you to do, the tax department, it allows you to estimate how much money you're going to make or lose over the next 12 months once you've rented out your property, because then we've got a baseline. And then you can get your depreciation schedule, and we can do that over a year and then divide it over 52 weeks and actually get our money back to the tax department weekly, if you get paid weekly, or fortnightly if you get paid fortnightly. Then we fill out this form, the tax department approves it, and then literally you get the money back in your pay packet every week. And that's the way to do it. And it doesn't have to be negative geared. You can actually be positive geared. You can make money out of this depending on the interest rate. So literally when we started this program, people used to buy property. And actually I think Claudia is positive geared now, and he's getting money back every week. You can buy a property and you're actually losing money on paper, but getting money in your pocket every week. And that's the whole name of the game. This is elite level tax work that you can do. And this is what the rich do. If you had an owner occupier and one investment property where there is currently both 100,000 equity available, and this will be used to pay as a deposit for the next investment property, which one would you use to take out the equity loan from, and which is better and why? Barbara,
Take it from both. I'd take it from both and buy two properties.
Barbara, high five. I love your work. See,
it doesn't make any difference because you're still going to be in an interest investment rate, whichever property you use.
Exactly.
But yeah, if you've got 100 on each,
do both.
Two properties, done.
Yep. Be like the what was it? Domino's they had this ad for this the tacos, soft tacos, hard tacos. Which one do you want? They said, boss, do both, right?
Yeah, pretty much. Doesn't matter which one you take it from, really.
Adam said, Robert, the extra cash flow, put it on the offset account towards the principal place of residence. Absolutely.
Yeah, 100%.
Thank you, Adam. That's really good. Adam really knows his stuff. He's been around for a while. I don't have a PPR. There you go, Robert's a red Vesta. So you put that money in the highest interest rate investment property you have, Robert. That's all you do. That's the second best one. Okay, this is great. What we're going to do is we're going to stop our live stream because now we're going to go in depth in our little private group. Everyone else watching us, thank you. Now remember, if you want to do your super, type in #super, and we're going to help you get a property. If you got 100,000 plus or more in super, my team will reach out to you. And I'll see you next Thursday night. So thank you for joining us.